Well, good afternoon, everybody. Welcome to our Trading Index Options webcast. I'm Connie Hill. Happy to be here with you today. And I think this is a kind of a class that is one of those that could really get you excited as far as being part of your bread and butter strategies. Okay. Today we're going to, I'm going to say, honor sort of a request from somebody who responded to last week's class and said, "Hey, I saw this other thing. Could it be applied here?" Well, we are going to apply it here, and I'll show you what I'm talking about here in just a few moments. Now, I am joined in the chat by good friend and fellow coach Barb Armstrong. She's a great veteran of the markets. I know lots of you enjoy her classes. She's here in the chat. We'll both keep our eye on the questions that come in, and if there's some that I can't quite get to, Barb will help me out with those. But we do want to hear from you. We want to know what your questions are. And if you have questions like some of these other individuals did this last week, and I'm kind of honoring a request there, go ahead, chat it into the comment section on YouTube, because we go back and check that every day as coaches. Make sure you get your questions answered very quickly as well. I hope you're following us on X. I'm Connie Hill CS. Barb is Barb Armstrong CS, and we'll put out and post educational content throughout the week, things we're noticing in the market, maybe some things on a given day, maybe give you something to think about that might help you. We'll post out there. So it's free, it's easy. Just give us both a follow. And let's get into our disclosures, because I have a pretty full agenda for us here today. What we talk about is intended for educational and informational purposes only. Don't consider it a recommendation. Past performance is no guarantee of future results. Any ticker symbol we bring up here is not to be considered a recommendation. It's just being used for illustrative purposes. In this webcast, we talk about European styled options and American styled options. American styled options that are short can be assigned at any time up to expiration, regardless of the in-the-money amount. We're primarily in this class dealing with European style options, and they are not assigned early. That's one of the kind of the nice things about index options. When we talk about probabilities or probability analysis, keep in mind they are theoretical in nature and not guaranteed. And we'll be using the Paper Money software application here today. It's provided for educational and informational purposes. I think it's a fantastic tool as you're testing out maybe some different, maybe new to you strategies or new to you rules or ways that you might want to trade a strategy. It's great to try it out in Paper Money before you do it in your actual account. All right, today what we're going to do, I have quite a few things in mind. And I want you to think about this question. If we could here today create a system where on most days you could trade an index option either bullishly or bearishly, that would hopefully keep you in the market a lot of the time. Would you be interested in that? Okay, what we're going to talk about here today might fill that bucket. All right, we'll give it a go here. Let's take a look at some of our previous SPX trades that we need to follow up on. And then we'll get into this idea of what we've maybe changed around as far as rules go. And we'll also look at maybe this idea of being able to devise a system where you're in hopefully most days. I'm not going to say every day because it's hard to be 100% inclusive on some things. But let's head on over to my SPX or to my charts here. Now, I have read a lot of your comments about wanting to see a white background or a lighter colored background compared to the black. And I know eyes are different, right? Some of you have perfect vision. That's not me anymore. But yeah, perfect vision, you can see black or white backgrounds. I have been using a black one for a while for some other purposes, and I thought I'm going to give it a try and see if maybe for our sessions, if this might help you out. Feel free to leave me feedback whether you hate it or you like it, as we are going to use it here today. All right, let's see. just looking to see if there's something here that I need to help with, but it looks like Barb is helping you out. All right, excess VLM is liking the white colored background. All right, yeah, you feel free to let me know. First thing, let's talk about some of our previous trades. And there were a couple of trades that we didn't actually review last week. And at the end of class last week, somebody said, hey, you didn't review this particular trade. So we'll kind of go backwards in time a little bit, see what happened with some of our options. Now, we have been doing a trade in our class with some very specific rules. And then we started to tweak those rules, okay? And that system, I'm gonna just kind of let it sit here, is called index options. And then some of the tweaks that we've been making to it, we're calling new index options, okay? The previous trade would be that if the index price was above the 200-day moving average, which is this green line, then would go ahead, would do a trade that's bullish. If it was below the 200-day moving average, then we would do a bearish trade. Well, you know, the SPX primarily, if let's go out here for say like 20 years, primarily it is an upward trending system, right? Again, this is a 20-year chart, and you can go, yeah, for the most part, it is that way. We have little pullbacks here and along the way, but overall, you're like, yeah, I might be bullish in it all the time. But there could be periods of time when you don't want to trade it bullishly, even though it's above the 200-day moving average. And so we were kind of devising a plan that maybe would help us with those rules. Now, one of the rules of our, I'm going to call it our original recipe, one of the rules of it said, all right, when it's 14 days out in our class, we are going to sell as long as, you know, the index is above the 200-day moving average. We're just going to go ahead with the trade. And when we meet together again in our next class, which would be the following Wednesday, we would close out that trade. Come sunshine or rain, or regardless of the position that that spread was in, we were going to close it out regardless. So we're really trading a fairly short time frame. And so the thought was, you know, maybe 200 days is not realistic for somebody wanting to trade a shorter time frame. So we started experimenting with some additional moving averages. Now on the screen, you can see this green line is the 200-day. This red line is a 50-day moving average, so kind of an intermediate type trend. And this blue line here is a 20-period moving average. And so you can see over here on the left-hand side, kind of the new rule structure. We said, okay, if we're going to go bullish on it, it needs to be above the 200, which was already a rule, but it also now needs to be above the 50 and above the 20. Now we are doing something that I'm going to say we're forward testing these rules, okay? MACD was on here just because it was an original one on the study. And ADX is on here because this tells us trend strength. Trend strength, regardless if it's bullish or bearish, we can know, hey, is it strong or weak? A value of 25 or higher means the trend is strong. And so right now you can kind of see short-term trend. It's been pulling back a little bit, maybe on our 50-day moving average. It's still heading up, but maybe it's starting to flatten out a little bit here, right? And so you can see over the last, say, couple of weeks, that ADX line has gone from about 26 and change, where we would put it in a strong trending category, to today it looks like it's about 19.9 or so. Okay, so that falls it more into a category of weak trend or trendless. All right. Let me look at what Mark says here. Oh, Mark's given a comment. I'm going to eavesdrop here to Jay Richardson. The comment says, my back testing strategy used the new index option rule. Exit, I didn't model the exit early if condition. I need to look back to see if it ever occurred, and you don't think it did. So yeah, Mark, tell us what you were also using on your exit condition, because that's where we kind of got to last week was, okay, let's get some other rules. Yeah, we're going to get out at the end of class or on our class time, right? A week later, but what might be some other places we might want to exit? So before we get to that part, let me just go back and show you what happened with some of our trades. We're going to come out here to the account statement area. And we have been trading the SPX index. It's the most liquid, and it seems to have the better spreads because of the liquidity. And man, it gives us a lot of possibilities with daily expirations. And that's one of the things that is attractive to people about trading that particular index. So we got into a couple of trades, and I'm just going to kind of maybe go back. Class day was the 24th last week. This was the 24th. And so just kind of a couple things that had happened there. We're typically selling a spread here. So we're going to be looking for positions to open. And then when we're rolling it or closing it, then it'll say over here to close. And so we're not going to look about quite yet at what happened the last 2 days, but previously we had 2 days in a row where we were able to ladder in an SPX trade. And the first one, had a nice fat credit there of 260. And on the second one, which was the next day on the 18th, it was a significantly less credit. It was $1.80. All right. We'll come 1 week after the 17th. That was our class day. That was the 24th. We went ahead and got out because we do come sunshine or rain, although I do think, let's see the timestamp here. That is looking, that's about 1:30 my time, which would be in this class, but this might have been after the class is over. Okay, so I probably meant to do it in the class and didn't actually do it. So I went ahead and closed it because that is our rule. And so we had to buy it back for $2.40. So we did not capture a lot of premium there. 20 cents is all, or $20, right? Which usually we want to capture a lot more than that. Okay. Then last week, it did not qualify for a new entry. Why did it not qualify for a new entry? I'll show you. Let's come over here to the 24th of June. That's the 26th. Here's the 24th. So this is where we were last week at our class time. And it was kind of sitting on the 50, but it was not above the 20. And so our new rules, we said it's got to be above the 50 and the 20 to go ahead and do a bullish trade there. So we held off. We didn't do it. In the last couple of days, what has happened? Well, finally, yesterday, it closed above both again. All right. So momentum is starting to swing back up. So we did enter a trade here yesterday. And normally we would do this in class, but I did it earlier in the day. Okay. And let me show you which ones we have, what we're doing with them. Let's see. We had 260. We bought back for 240. And then the one that we got on, I think this is the right one. Let me make sure, 72.50, 72.30. We bought this with this one. We brought in $1.80 credit. So not quite as juicy as the 260, but we were able to buy it back yesterday because that was going to be 7 days. Actually, no, it was getting closer. I think we forgot to do it. And so its expiration date is July 2nd, tomorrow. So it was like, oh man, we need to be out of this trade. We should have been out of it a few days ago. So we were able to buy it back for 45 cents. So that one was a little bit more satisfying, I'm going to say, right? Because we brought in $1.80, had to buy it back for 45 cents. So our net there is $1.35 or $135. All right. Then we did the two new trades, one today, one yesterday. Our trade of yesterday, our strike price was 7,200. That's our short leg. And then 71.80 is our hedge leg. Gave us a credit of 170 on that short put vertical. Today, and I did this a little bit earlier in the day, market had been open at least here for about 3 hours. And we went ahead and I looked at the chart. I could see it was still above the 20-day moving average here. So I went ahead and put the trade on. Now the strike prices we put on there were 72.75 was our short leg. And then we usually widen it by $20, a $20 wide spread on these. So then we went 20 strike difference to 72.55 is our hedge leg. That brought us in a $1.60 credit. Now today, where do those stand? And I'll show you. The one that we did yesterday, we collected $1.70. It's down to 95 cents right at this minute. It has been fluctuating between, say, $1 and about 80 cents. Okay. So it's like, hey, that's pretty decent in a day, right? That's pretty decent time decay capture. Today's trade, we brought in a $1.60, and the index was up a little bit higher than where it is right now. And so makes sense, we're down on that one a little bit, not a ton. Instead of a $1.60, it's right now at a $1.70. So it's showing that we're down on it a little bit. Okay, basically $10 on the trade. Okay, so if you are trading these along with me, that's what we've done in the last couple of days. And we kind of put forth this idea that, you know, could we try to trade this many days throughout the week and not just on Wednesdays? There's nothing magic about Wednesday, right? It just happens to be the day our class meets. And so that idea was, okay, every single week we're going to do something 14 days out. And then by class time, I'll try to be patient next week and not do anything without you. Okay. And then at class time, we'll either roll, which basically just means closing down one trade and opening up another one, but we're just doing it in one ticket. It's still going to have the same amount of commissions and fees as if we had done it separately. So some of you that are like, not so comfortable with rolling yet, then what you might want to do is close down the one trade, open up the new trade, right? You could just do it on 2 different tickets if it helps you understand and kind of keep track of what's going on. All right. We may have a couple of questions in here. Let's see. Looks like Jay Richardson and Mark Denny have been talking about paper testing some revisions to these rules. So yeah, I'm happy to see that. Feel free to fill me in on that. Okay. Mark says to Jay Richardson, so far in your back testing that shows the super trend, which I forgot, that was something I think that was mentioned before. I need to write that down again as a potential for us to look at in terms of, is it something that might be useful to utilize in our rules? So you're experimenting with that right now, see if it's better than the moving averages or the market forecast. All right. That'll be interesting to hear what you find. And I will tell you, you will get a lot more out of understanding rules, feeling comfortable with rules. If you'll go along and paper trade some of these trades that we're doing, if you'll do that in your paper trade account, it'll keep you engaged and it's going to have you thinking, right? You pull it up one day and you're like, the SPX is below the 20 and the 50 all of a sudden. What do I do? Right? And you can work through those kind of questions. Okay. So that's why we have trades on for today and tomorrow. I mean, yesterday. What if it's above it tomorrow? I'm going to do another trade. Now, how do we pick our strike prices? Okay. On the other side of this grid is just basically the price with some implied volatility. And then we're using what's called the probability of expiring cone. And it's just a study. We come up here. And that was a question one of you had as well. Where do we get that? That's where it is. Probability. I just type in prob and that's the last thing left, right? Of expiring cone. And on here, I think the default is actually a 100 period here, which means how much time do we want the cone to cover? But if I were to just kind of put this on here, and leave on my 30-day time frame, the cone itself looks the same for that period of time, for those 30 days. Okay. It's just that this would go on longer, saying it's 100 period. So what we had been using, what Ben was using, was 30, and I just kept using it, right? Because quite honestly, we don't need it to graph a whole 100 days on us, because we're just looking here. Let's get rid of this guy. We're just basically saying, okay, where should the index not be? If this in our probability cone tells us where the index is likely to be after 2 days, 3 days, 4 days, and going on out, where is it likely to be? Where is it not likely to be? So this line here we did a couple of weeks ago when we said, okay, for the options that expire in 2 weeks from now, where is it not likely to be? This line here, this is the one I drew. Let's see, it's on the 14th. So this was the line that I drew yesterday on the probability cone when finally it met the rules again, that it was above the 200 and the 50 and the 20. And the other signal we were looking for is that we wanted the blue line to be in the market forecast enhanced study. Let me just go back to that. We wanted to make sure that the blue line was either heading up or in this upper reversal zone, or if it's down at the very bottom of the lower reversal zone and it's like 5 or less, it is likely, not guaranteed, but likely to start bouncing up from there because it can't bounce down anymore. 0 is the bottom. And if it's already sitting at 5, then it could be likely to bounce. Again, not guaranteed. And so that was part of the factors here as well. Our blue line had been going up yesterday, which was nice. And it was still in this upper reversal zone, which means lots of bullishness. If the blue line comes down out of the upper reversal zone, then that might be starting into a little bit of a period of maybe a short-term pullback or maybe a little bit of a correction. Okay, so that's why we went ahead and said, great, we'll go to the next step, the probability of expiring cone. Now, when I did that today, I had my line here from yesterday. That was July 14th. Today, I moved it, and it's only a little bit, right? And we're looking to sell a bullish put spread. So in this case, we're just right now using the bottom part of this cone, because if this is where the index is likely to be in that period of time, we want to sell something that is where it's likely to not be. Okay, so put my mouse right here on today's date of the 1st, knowing that this would expire on July 15th. Let me get it exactly where it needs to be. Okay, it needs to be right there for the 15th. And it was just a little bit lower than where it had been yesterday. Okay. And so here, I think at my short leg that I did here was 72.75. Let's go make sure that's really the case. Yeah, 72.75 was just barely under the probability of expiring cone. So since it's not likely to be there, that is why we did our spread. So the 72.75, spread it out by 20 bucks. That gave us our hedge leg at 72.55 and created that 160 credit. Now, let me see what kind of questions you might have up to this point, because we're going to shift gears a little bit here. You need the link for the new market forecast enhanced. I have it sitting right here for you. And I've also been pasting that, although it might be a different formula because this one I just created a few minutes ago. This new market forecast enhanced, for those of you maybe that weren't here for that, basically you can pull up market forecast studies out of your studies. This is a ThinkScript that's been shared that kind of tells you up here what is the exact value of the red line momentum, and is it going up or down? This says it's falling. The near-term line, it is in the upper reversal zone. It's at 92 and change. It is falling, and then it shows you what the intermediate line is doing and the actual value. It's going up right now. So the kind of the generic one that's out in your studies, it doesn't give you that. It doesn't give you the upper and lower reversal zone. You just have to know 80 and above is the upper reversal zone, 20 and below is the lower reversal zone. This just makes it very graphic. Okay, so let me copy this over for those of you that are here live. For those of you that are not here live, let's do this. Let me paste it. Oh, I've got to fix my text boxes too, don't I? Look at that nice black line. I have to point to see where the drawing tool is. All right, I'm going to paste it in the box here. Those of you that are listening to this on the recording, go ahead and pause. Go ahead and write this down. MFE stands for Market Forecast Enhanced. Okay, that's just what I call it. And you can go from the exclamation point over, grab all those 9 characters. They are cap sensitive, so you have to make sure to do it in all cap. If it's capital letter, make sure to include that. All right. Let's see what else we have here. Scott wanted to know, in selecting the short strike, what is a typical delta? And a question came in. I can't remember if it was, I think it might have just been in the comments. And wondering, I think it might have been, is it always at 13 or is it always at 14 or something along those lines? And I'm going to say it doesn't necessarily always have to be at a particular delta, but say, for example, the ones that we did today. So let's go to 7270. It had a 14 delta. And I find very frequently when we're putting on this trade in our class, that is a pretty common range. It's usually in the teens, usually in the lower to mid-teens. But it doesn't have to be it doesn't always have to be a 14 delta. Okay. In your case, as Chris is maybe saying, usually it's about a 16 delta. And that could be because we're making our own assessment there, right? We're using our judgment and we're deciding, okay, where is out of the probability cone and how far do I want to be out? And I just try to go just barely out. Okay. But you could modify it for however it made sense to you and for your comfort level. All right, great question there, Scott. All right, so we've given you the link for the market forecast. Yeah, thanks for helping out here, you guys. Appreciate that. Okay, Chris says, could set up the exits for specific date and time with conditional orders. And that's something I wanted to explore a little bit more with you. Instead of just saying, hey, we're going to get out at our class time, we decided one rule last week to add on to this evolving structure here. If we could exit early if we found that the index was below the 20 and the 50. I should put a little space there. Moving average. We are not going to wait till it goes clear below 200. That's way too much room. We've decided we're more interested in these shorter time frames. So we could get out early if it falls below there. And I put an or condition here, or the green and the blue market forecast line is down. Okay, so they're both, well, this one's going up, this one's going down, but suppose they were both going down and the blue line was out of the upper reversal zone, because we stay bullish as long as it's in the upper reversal zone. Like it is today, it's up in that range, but it is pointing down, but it's in the upper reversal zone. So it's valid, it's bullish. We're going to keep going that direction. But say the blue line came down out of the upper reversal zone, it was heading down, the green line was going down, and you're like, okay, I want to close the trade based on that. You could, as opposed to saying it must do all 4 of those. Okay, so we're going to say it's either below the moving averages, one condition, or these lines are both headed down. And if you want to use that, you could use that. The other piece here is, what if we wanted to put in a percentage of a target? Like saying, hey, if we get X percent of the value of the spread initially, would get out of the trade. We could add something like that to our rules as well. And some of you have been commenting about that a little bit. Okay, so since these are kind of our class rules, and I'm being very diplomatic about it here, in terms of saying, okay, I'm going to ask you guys, what percent do you want to use for our rules that we're going to try out right now? Okay, do you like, you get 30% and you're out? Are you a 50% person? Are you an 80% person or a 70% person? Right? Let's, as a class, decide what we want this percentage to be. Now, I have a number in mind. If you say 14, I'm probably not going to go for it. I would want to get a bigger profit out of that. But as you type that in, I think it's helpful to know that we sold this one yesterday for 170. And if we were to get 50% of that, what would that be? That would be what? 80, I guess 75, almost 75 cents, 72.5 cents or whatever, right? So we would say, man, we were getting really close to it. We might have even hit it at some point today, even though it's not showing it at that value right now. Okay, we've got 80, 80, 50, 50, 80, 50, 60, 50 to 60, 60, 85, 75. Whoa, 100% for you if you started at a 20 or lower delta. Okay, yeah, it might be a little bit of a range. Ooh, okay. That was a real close tie between 50, I believe, and 80. So I'm going to just come up here and just do a quick count. You can help me count as well. 80, 80, 80. Bogus, I'm going to count yours as an 80. So 4 for 80. And then 60s, we've got 1, 2, couple of those, and then 50, 50, 50. So we actually had more 80s than 50s. Unless I didn't count one down here. Okay, we're going to go that diplomatic way right now. Right now, this can change as we experiment. We're going to say, new rule, we're going to allow ourselves to get out early if we have 50% of our target. Okay, so what does that mean? Well, it means for these two trades we have on now, this one we just put on earlier today, we're going to add that as a condition. We're going to go in and say, hey, if we get 50% of $1.60, which would be what, 80 cents, or $1.70, which would be, I guess, 85 cents, right? Then we'd be happy to get out of the trade. Okay. Let's do it for one of these, and then after class, I'll do it for the other one. Let's do it for the earliest trade here. We'll say create closing order, go buy it back. I think that original was 170, right? Yeah, 170. Okay, so 85 cents. We should go buy it back for 85 cents. Ooh, we're getting close to it, aren't we? And because I'm gonna double check this. Make sure I'm not making things up. All right, my little calculator said yes, indeed, it is 85. Let's put it GTC. We could be out before our class is over. Okay, based on 50% gain. All right, let's hit confirm and send. And of course, this goes to our index options. We'll see by the end of class if we're out. Now, if you wanted to put this on when you put on the trade initially, that's what I'm going to recommend. We're just coming to a consensus here today about what percent we're going to use. But from now on, as we put these trades in, and if I see it tomorrow, I'm going to put it in, get us out at 50% if it goes there, right? We're going to say early capture. We're not trying to get every piece of meat off the bone. We're just trying to take the biggest chunk off the bone. All right. You guys, appreciate your participation here. Ricebird said if it buys back on that trigger, rinse and repeat. Sell it again, sell it again. A question here, I think this is, if you exit early at 50%, what is your loss exit? We're not going to put a loss exit on this one because we're going to have to use our eyes. So we're going to take the profit if we get it, but then we're going to have to use our eyes to let us know if it's down below the 20 and the 50, then we need to exit. Or if our blue line and green line are headed down, then we need to exit. Okay, so I'm not going to say it's impossible to code that in, but that would be a lot of parameters to be putting in there to try to automate it. However, if you can automate it, more power to you. Okay, I like that. Adish Mehta says, how to backtest if this strategy will beat, oops, turn that off. How to backtest if this strategy will beat buy and hold on the S&P 500. You're just going to have to do that yourself, right? I actually wrote down some percentages today. SPX year to date, so the first 6 months of the year, was up 9.55%. The NASDAQ, 19.91%. Russell 2000, 21.86%. And the Dow Jones, 8.85%. Okay, so you would just have to decide what period of time you want to do it over. And you could do some testing to see. Because yeah, we're all out. Well, maybe you're not, but most of us are out to beat the market, right? If we can't beat the market, then we're wasting a lot of effort, right? Where you're like, I am putting a lot of time in here. I want this to be paying me better than just sitting in an SPX index fund or something, right? So do it. You can go ahead. And as you can see, I'm open to any information that you get out of your back testing, want to share with the class. We're happy to have it. All right. Let's see. Sam's letting us know early withdrawal penalty exiting trade is the implied volatility at the time, specifically the intrinsic or extrinsic value. Okay. All right. Now, we're not quite getting to where I wanted to go today. I spent too much time on this piece, but I hope that's been helpful to you. So I'm going to lead into my next thing that I want to cover. And let's just say this may cover a couple of weeks. We'll get started today, and then we'll get further into it next week. I'm going to head over here to comments that were made about our class last week. And some of you may have had that question. So it was Mickey that had the question here. When you're using that probability cone, is it usually around a 14 delta? Because some in our class, a lot of them have been 14. And that's what they have roughly been, but they don't have to be that way. I think another way that you could do it is, you could go to the probability cone and maybe there's a few that you're going to test out, you could do that. Maybe you're looking to get a certain credit. Oh, well, if I get a 14 delta and I get, this was giving an example, the $2 credit or whatever. Yeah, you could kind of do some blending. All right, where I wanted to go in our class today goes to the comment made by, I'm going to call you XS because your first letters are X and S. So I'm going to call you XF. XS said, got thinking about this idea of maybe being able to determine one day to do something bullish, the next day to do it bearish, depending on some parameters. And he watched the class that Cameron May did last week. And he said, as I was listening to this class, I was wondering if maybe we could do something like this. And this is kind of the next strategy we're going to test out here, okay? If SPX is significantly over the mean, the class was on linear regression, okay? I'll show you that. Maybe if it is significantly under a mean, which means it's likely to bounce up, maybe we do a short put vertical. If it's maybe on the top side and hitting a linear regression line at the top and maybe is going to bounce down, then maybe you do a bearish trade. And that's where I said, maybe we could work on creating a system that would give us the opportunity to be in the trade. I'm going to say a lot, but it's not going to work out every single day. So let's head back to our charts here. While I'm over here, the way that you're able to find our classes easily is if you're a YouTube subscriber. There's a little blue YouTube logo in the bottom right-hand corner. Click on that. That'll subscribe you. And it helps you to find our content easier. You can come down to our playlists. After we talk about this class of Cameron's, you might want to go check out this class of Cameron since in the short verticals, and it's what he taught think it was just last week that he taught the class. So as we come back here to the charts, we're going to do some hiding of studies right now. I'm just going to hide these rather than getting rid of them altogether. And I didn't erase this. We're going to put on 3 linear regression lines. Regression, not aggression. Regression. Let's hide this guy too. All right. Type up here the word linear. And you'll see several choices here. Now, what we're going to do, we're going to put in a linear regression trend line. Okay. We're going to add that. And then we're going to add one that says linear reg CH50. And the one right above it, CH100. And we'll talk about what these mean. And like I said, I was hoping to go into bigger depth on it today, but it's not going to happen. And so we're just going to start on it. And I wanted to have a 1-year chart up here. Now, I went in and made the lines a little bit thicker, I think, although they look kind of thin there. No, I didn't make them. When I was experimenting earlier, I did make them thicker. So they're kind of thin here. We just threw them on. This line in the middle is what we call our mean. And the mean really represents the average, the normal. And it tries to plot as many lines, as many data points, I'm going to say, which would be candles in this case, along that line. And wherever it can get the most touches, that's where it's going to draw the line. That's going to be our mean or our average point, our normal point. Then, so that's the first line we put on here. Then let's talk about this red line. Now there's one on either side here, and you're going to notice they're equidistant from the mean. But what has been plotted here is the absolute either lowest point or highest point. In this case, it happened to be the lowest point, okay, that it graphed. And so wherever it goes the furthest, then this line on the top is going to be equidistant from the mean down to where that line is, whatever that distance is. It's going to replicate it up here as far as the distance goes, okay? And that's what that 100 means. Basically 100% of the data points, okay? So 50. This green line is the 50. And it really represents kind of a 50%-ish range, okay? Instead of 100% like the red lines, it's about 50. We might think would get a few more touches on it. And actually, looking at it right now, it doesn't really look that way, okay? However, when we see these lines here, they may act as support or resistance for an index, a stock, whatever you happen to be looking at. And the idea here is when it hits this extreme support area, it's likely to do what? It's likely to bounce the opposite direction. If it comes up here to this 50% line and hits it, what's it likely to do? Well, it's likely to use it as resistance and roll over and head back down. And so the idea would be, oh, maybe we could use this to test and see if we could potentially use something like this so that we could be in a trade, either bullish or bearish, kind of following the general trend, but also using these regression lines as resistance or support if they're on the downside of that mean. Okay, now we are out of time right now. My time is up, although we've had fun. But this is where we're going to be going. Okay, we're going to go more in depth on this week. And if I have the opportunity to place a trade, I will use the probability of expiring cone as one set of trades, and I'm probably going to go out and group these, okay? But if, for example, we're getting a nice little bounce here, and there's room for it to head up to this line, then we might go ahead and place a bullish trade on it because it came off here and went up in a bullish direction. If I had more time today, we would place a trade based on that, okay? All right. Well, you guys remember tomorrow is options expiration because Friday is legal holiday. The markets are going to be closed on July 3rd, which allows you to get prepared for your fun that you're going to have on July 4th, right? Get all the barbecue stuff ready. All right. Now, we're going to take a little break in our programming. Scott Thompson's going to be up next with, and thank you for putting that in there, Barb, stock investing for beginners. Okay. Those of you that have even been in the market for a while are really enjoying that class as well. All right, we'll see what happens with our SPX. I hope this makes sense, that we're basically trying to build some different systems so that we can trade the SPX on a frequent basis. All right. Thank you, Barb, for your help in the chat. They kept us pretty busy today. All right, we'll see you next week. See how our SPX trades are going. We'll see you then. Bye-bye.